Well, thanks so much for tuning into Talking Point today. I'm Neeraj Shah, and the Talking Point today are the views of Sameer Baisiwala. He heads pharma and property coverage at Morgan Stanley and on the sidelines of the Virtual India Summit 2022. He joins in to talk about his thoughts on at least those two pockets, and both of them pretty intriguing in the manner in which developments have happened around both of those. Sameer, great having you. Thanks for joining in. Hope all is well.
Thank you for having me over here.
The pleasure is ours. So we're wondering, how is the interest for rate sensitives in general and thereby property in particular, considering what's happening around the world with rates and considering what our own RBI has been doing in the last couple of months?
Yeah, and interest rate upcycle is typically a headwind for the property sector. You're right on that. It impacts them on multiple levels. So starting from the higher mortgage rates feeding into lower demand, then typically these days would be leveraged, and so therefore higher interest outgo, and then it obviously impacts the valuations through higher WACs and higher cap rates. So those are the usual levers which hurt them. But I would having said this, I would just contextualize it that we are not at the peak of any cycle, neither valuations nor fundamentals. We are probably three quarters into the demand recovery. So I think that we got enough and more leg room to grow as we go forward. So the starting point is actually quite nice. And second, on valuations, I would say these stocks have all corrected 30-35% already through the course of this year, and the valuations are more closer to the mean. So again, when these interest rate upcycle begins, I think our starting point is not too bad. So which just tells us that putting the two together, that the impact should be fairly muted. And just a final point I wanted to make here is that the mortgage rates have come down from 11% to about 7% over the last 4 years, and if it goes up to 8.5%, frankly, in the real market, in the real world, there should not be much of an impact. Only if it goes beyond that, that's when we should start to worry.
Okay. Sameer, when I looked at the presentation or the note that you prepared, it's fairly exhaustive in that it also looks at what's happened ever since 2004 and how during each of those cycles, naturally there were different winners, but different themes which worked as well. Uh, what's your sense about what could work the best or the least over the course of the next 2, 3, 5 years, as you might define this current cycle to be like?
I think it's a great question, Neeraj, and two ways to think about it. If you said 2, 3, 5 years, I would say 10 and 20 years also.
Okay.
So see, India is a young population. We actually did some work and contrasted this with the Chinese market, how it has evolved. So right now, Chinese market is roughly 1.4 trillion dollars, at least pre-COVID, the size of the property sales every year, and we are probably at 1/10 of that. So see, there are very clear factors. The most important, I would say, the per capita income is $2,500, and the explosion in China's demand happened when the per capita moved from $4,000 to $8,000. So over the next 10 years, we will hit that sweet spot. So right now, people are probably buying more white goods and autos and stuff like that. We will come to a tsunami of demand, and my guess is we are about 8 to 10 years away from this, when the need for housing would just explode. And that's really driven by the per capita income. Second is the age factor. Our median age is 27. China is more like late 30s. So the moment India hits 35-year-old age as a median, that's when you would see that's a buying age. There's a new buying age, frankly. You would see a lot of, so there are quite a few of these demands, these factors, which tells us that over next every 5 years we'll be moving to a higher trajectory. That's one. So that's on a long and very long term view. But now, if I think about 2 years to 4 years, I would say we are coming from a 6 years of hibernation in property sector. If you see, the volumes are down 25% for every year in last 5 years versus the preceding 5 years. So we were actually doing significantly higher volumes in 2011 to 2015 than the next 5 years. And
Okay.
and while during at this time the incomes and everything has risen, significantly. And second thing is property prices were flattish for last 5 or 6 years,
Hmm.
almost 2% CAGR. So it just means, and incomes were growing at 6 to 8%. So in real terms, the property actually got cheaper by 30 to 40%. So now that kind of takes me to the next 2 to 4 years sort of a time frame. And because of this pent up demand and because of this higher affordability, other than the home upgrades driven by COVID, and the fact that there's some wealth effect from the equity markets, capital markets, a lot of these factors playing into it, I think that we are in a very good demand situation from this on this time frame.
Okay. So what are your set of large investors wanting to know about the most? Are they wanting for the are they looking to get advice on the pure play residential property developers, or are REIT companies in focus? And of course, rising rates kind of challenge that too. Where is the maximum interest, and where is it that you want to tell them to look for quote unquote bargains?
Well, Neeraj, to begin with, I would say that there is some interest.
Some interest. Okay.
But versus there was, this was quite an irrelevant sector in the sense that its representation on the capital market was very tiny. It was under 1%.
Yeah. True.
So they were 10, $15 billion market cap. Market was about $2 trillion. Frankly, we can talk about it, but but today I'm happy to say over the last 3 years, because of new REIT listings, new IPOs, and the stocks having gone up a lot, today they represent 40 to $50 billion on the market cap, and that makes them somewhat a little bit more relevant. So see it in that context that they are not the main show, when it comes to capital market. But having said all of this, it's a very important asset class, both property by itself and then property on equities, both of them. And now people are getting more and more confident of the business model, of the corporate governance, of their balance sheet, and of the promoter pedigree. Each of these things were missing in the last 10, 15 years. You know of the fatalities that we had seen in the previous bull market. Those companies
Yeah.
are to be seen around here. So there is some interest, Neeraj, to be sure, and it's across both Resi and REITs, and within Resi, it's South India or North India or Mumbai. So all these plays are highly relevant to us.
And you reckon there could be some merit in that argument that a lot of people make. For example, there's a common belief that, or there's a near consensus belief that watch out for residential properties emanating in Bangalore or some of those tech hubs, simply because the demand cycle might be very strong there for the 5-10 years, simply because every techie's made money and they will at some point of time spend in real estate if not already.
No, that's a very important point. If you see, we started this journey in 2004, which is what your previous question was. Each of these vibrant economic micro markets in every metro is around IT hub. I mean, there's no question about it. If you think about Gurgaon, it's all about cyber city, and then this whole neighborhood around it. That's really the gravitational force for employment, and therefore, and all of them are white collar jobs. So,
Yeah.
which is what feeds into the real estate demand. And then there's a multiplier effect, because then there are service providers, transportation providers, food providers, telecom into these IT hubs. So it has a multiplier effect in that sense. So these are the vibrant centers. You look at Gachibowli in Hyderabad, you look at Whitefield, ORR in Bangalore, you look at OMR. So, and these are IT centers, and 5 to 10 kilometer radius around it is a residential hub. So clearly, I would say, hard to put a number, but I would say 50 to 60% of the housing demand that we've seen over, say, a 10-year or a 12-year period is coming from directly, indirectly from IT sector. So therefore, fast forwarding it, next 5 to 10 years, I don't think this is going to change. But having said that, a domestic economy also is doing very well. You look at any of the banking sector, pharma sector, consumer sector, SMEs, what have you. So even that would be an important pillar of growth. So it would be a combination of the two.
Okay, which lets me to take a segue. So, I mean, I'm just sorry, before I get into pharma, and I understand you would have paucity of time, but just very quickly, I don't want to get into stock specific names, but are you more constructive on residential developers in a particular geography or REIT companies which may be present in a particular geography? What is your preference list like? Let's not get into names, but just give us a flavor.
Yeah, sure. No, I think it's an important question. So right now we are at that stage of demand recovery where it is very pervasive. So players in Gurgaon are seeing very strong demand. You see Mumbai players, they've reported very strong numbers. I would say, and so is true for Bangalore. If you see fiscal 22 pre-sales number by each of these players, and eight of them are top listed developers, is higher than what they've ever done in the last 5 to 7 years. So you find that in that presentation deck which I sent you. So it just tells you, and then within each of these cities, it's across micro markets. So South Bombay is doing well, Central Mumbai is doing well, Eastern suburb, Western suburb, Thane, Navi Mumbai, everything is doing well. And then it's across ticket size. So 1 crore or mid income 50 lakhs, 70 lakhs is doing well, and super luxury 20 crores, 40 crore apartments, they're also doing very well. So I guess the point I'm trying to make here is that it's very pervasive, very broad based. And so therefore, location or the geographic presence is probably not the stock picking criteria. I
Okay.
would to that I would add who is ready to benefit from this trend in terms of new launch pipeline, the depth therein. Second, who has managed their balance sheet well over the last 3, 4 down years to have become more deleveraged, and finally, who has more reasonable valuations. Once you have each of these four components tick for you, that makes for a good investment.
Quick 30-second answer, Samir. Your note had this line which said magical US $1 rental rate per square feet per month. What is the implication of that? Why do you call it magical?
Yeah, because you see, the rental rate has, I try to put this in 30 seconds, but 10 years back, the rental rates in these markets, each of which I said was 40 rupees per square foot per month, moved to 60 rupees and now moved to 80 rupees. Rupee has moved from 40 to 60 to 80 rupees per dollar. And so therefore, and 80% of these tenants is all multinational companies. They are IBM, Accenture, Google,
Ah,
Microsoft. So what is for them, it's the rental rate has remained $1. So that was a reference.
interesting. And therefore, the demand might stay strong for those. Like, that's a great statistic. Thanks for that. Samir, thanks for that. Yeah, I've taken about 13 minutes of your time. I'll probably take 5 more if you have.
Sure.
Okay, great. Would love to talk about pharma. Q4 was very fairly muted, I thought, and most analysts on the street believe that the margin recovery, if any, would happen only post the second half. How does the sector then do in such a scenario from here on the next 12 months?
See, on a relative basis, muted result is a very good result because they are not reporting, crater in the margins or sharp fall in the earnings like many of those which have been. So I would say nearest two or three things. First of all, pharma demand is very resilient through these macro troubled times. It has not been shaken, unlike say cement sector or a chemical sector or what have you. So demand is absolutely intact, whether it's India, outside India, US. So the volumes are remain very strong. Second thing is the most heartening point, if you ask me, when everyone else is being pulled down because of the input cost inflation, it's not true for pharma sector. Most of these companies, I won't say all, two or three have been outliers, but most of them have reported stable margins. So they may have
Mhm.
been down 50% to 100 basis point. With current inflationary times, it's very livable. And the reason for that is they have been able to pass a fair bit of this onwards to their end customer. So a lot of these branded markets, Indian emerging market, they've got fair bit of pricing power. Second is the revenue mix, and third is the complex launches. So put all these things together, they have done a pretty okay job in maintaining their margins. Now coming to fiscal 23, you're right. First half is going to be okayish, maybe more of the same. And second half is where we are looking at some of very interesting large ticket size, high margin launches in the US. And as and when that happens, I think that will definitely make the numbers stable to look up.
So the US generic catering companies, and I'm not asking you to name, but just for simplicity so that people understand, the Suns, Lupins, Dr. Reddy's of the world, that bucket is something that might see launches and therefore selectively might have benefits coming in the second half, you say?
Yeah, it's going to be fairly broad-based.
Fairly
Yeah.
broad-based.
So a lot of the names that you said and more will have, and it's not a, it's a very, very public information. So drugs like Revlimid, which are $8 billion in sales, at least, 4 or 5 guys are going to launch from India with a volume control and high pricing environment. And there are more inhalers, complex injectables,
Got it.
other launches coming through. Um, Sun, as you know, is doing a fantastic job in rolling out global specialty business. That was up 40% in fiscal 22, and now it's 15% of the total revenues. So a lot of this, high-end, high-value, high-margin stuff is going to come about in the second half.
Okay. One more question, and then we'll let you go. I promise, Sameer. And that's on diagnostics, simply because it's the space so much in focus. There could be a deal in the offing, but there is competition certainly in the offing there, and maybe a bit of a price war, as Tata 1mg would have us believe. What's your sense of what does the next near term hold in store for these companies, and why?
Yeah, see, first of all, it's a brick by brick business, if you ask me. You cannot buy and grow in this business in the sense that you have to go pin code by pin code, build up your collection centers, build up your brand franchise, build up trust that people give you the samples, and then build up the testing infrastructure. And then, so you cannot accelerate it beyond a point. It's a hard work. It's a time consuming, expansion, and all companies have to go through it. Second point I would say, Neeraj, is that we actually, people may call it, but we don't have a true pan-India players. There were regional players. North India guys are expanding into South India. West India players are expanding into elsewhere. In 3 to 5 years, when they've rolled out their whole infrastructure, that is when they can say we are truly a pan-India player. And we have in, say, for example, United States, 2 or 3 companies which are genuinely pan-US, pan-country. So that's on the player side. So it's gonna be, there won't be too many winners, in that sense. It's a lot of hard work, and only people who will roll up their sleeves are going to do well. Third point I would say is India is a very highly underpenetrated market for diagnostics. My guess is some statistics say that 80% of Indians have never taken a blood test yet. So it just tells you that how much we have to go. And you don't need to fall sick. You can do a preventive or wellness blood test also, by the way. So the point here is, I think this industry, say 50,000 crore is a size, say $7 billion, give or take, will double every 6 to 7 years. My guess is more like 6 years. So we got a long 20-year runway to growth over here. So that's and it's an asset light model. You don't need to put a big, capex to grow. It's a very asset light business model, intrinsically speaking. So, good place to be in. But however, you're right. Right now, the competitive intensity is very strong, and so therefore, it's going through a very difficult times in that sense. And I think companies will have to fight their way out. And in this period, you will see some volume chip off, pricing pressure, and margin pressure. So companies will have to bear this. But looking beyond 2 years, I think it's going to be a very good area to be in.
So you reckon tech can disrupt it, or do you think companies will find a way around?
No, I think tech will enable it.
Enable it.
So tech will help reach into deeper parts of the country, but you need to back it up with physical infrastructure to move the samples. Samples can't go through internet lines, and people will need to do the tests. So,
okay, Sameer, thank you for being patient, but lovely talking to you today. Thank you so much, and have a great summit.
Excellent. Thank you so much.
Viewers, thanks for tuning in. Thank you, Sameer.